Guys, so when I in mortgages, pretty much as I work every day, the two most common questions I hear all the time: what is the right credit score to qualify for home ownership, and what's the best credit score to qualify for home ownership? And tonight, guys, we're gonna go over your credit score. All right, so we're gonna go over how credit works, what credit does to qualify for home ownership, right? So you need the right score to qualify. You need the right score to fit the right program, and you need the right credit score to get the best deal. And tonight we are going to go over qualifying, right, with your credit and how to prepare yourself to buy your home. Okay, so your credit. What is your credit? First, we're going to talk about your credit score. Then we're going to talk about credit bureaus. And then what credit score lenders use. We're going to talk about the best credit score to utilize the best deal. We're going to go over public records, which a lot of people don't go over. And last but not least, whose credit score can you trust? All right, guys. So tonight we're going to go over that. So let's go into what's your credit score, right? What is your credit score? Your credit score is a grade, right? Your credit score is a grade to decide, right, what behavior you have. Credit ranges between 350 to 850, right? Of course, 850 being the highest, 350 being the lowest, right? As you work on your credit, as you make all your payments on time, as your credit builds up and you have a higher limit with your low utilization and behavior of paying it back, it improves your credit score, right? And of course, the longer you have credit, the better your score gets. Okay, so guys, when you're thinking about your credit score, remember 350 to 850, right? 850 being on the high end. So who issues your credit score? The credit bureaus. There's three credit bureaus that issue your credit when you're trying to purchase a home, right? You have TransUnion, you have Equifax, and you have Experian, right? So when you go to a lender to run your credit, that lender isn't the company that gives you your credit score. They're gonna pull your credit. Whatever company they use to pull your credit, right? They reach out to the credit bureaus. The credit bureaus will issue you a credit score. TransUnion, Equifax, and Experian will each issue you a score. Once you get a score from each bureau, right? Then the lender looks at each score and they decide your credit. Bureaus use, depending on who you're borrowing money from, each bureau uses a different credit scoring model, right? So, for example, if you're buying a home, Experian, TransUnion, Equifax, they use FICO score 2, 4, and 5 credit model to give you a credit score. Of course, if you're buying a car, they use auto score to give you a credit score. If you're applying for student loans or credit cards, they use FICO score 8 to qualify you for student loans or credit cards. So it all depends on who you're borrowing money from. That's why a lot of times you can't judge, oh, well, my car dealership gave me this score and you're going to use that score to go out and buy a home, right? Or your student loans or your credit cards. That's why credit card apps aren't as accurate if you're trying to use that score to buy a house. So remember, each bureau will give you a score. But depending on who you're borrowing money from, what industry, that industry also has a different way they grade your credit score. So TransUnion and Equifax and Experian have a bunch of different ways. Also, they use the Vantage score model as well, depending on if whoever you're borrowing money from uses Vantage score. So remember, it's more than just the score. It's who are you borrowing money from? What industry are you trying to get money from? And of course, through that, they give you a score as well, right? So now we know that your credit score goes between 350 to 850, right? And now we know that when you go run your credit, you're going to get a score from Experian, TransUnion, and Equifax. That's why some lenders run one score. I don't like that. I don't like it when they run one score. It's cheaper for them to run one score. But the problem is, if it's the lowest score, you're going to have issues, right? So, of course, definitely, or the highest score. And then you think you have some score, but that might not be the score that lenders use. So remember, okay? So remember, that's why you need 3 scores. And remember, depending on the industry, that industry has to run your credit, right? So once they run your credit and you get the scores, what score should the lender use? So if you have a if you have a 850, 750, and 650, all lenders are going to use the middle score, right? So if you have the middle score, if you have multiple people helping you qualify to buy a house, they're going to use the middle lowest score. Let's say you have an 850, 750, and 650, and your co-signer or co-borrower has an 800, 700, and 600. They're going to use the middle score of the second of the co-borrower, which is the 700, right? So of course, there's multiple borrowers on there. Every borrower, they're going to take the middle score, and whoever has the lowest middle score is the score they use to grade the complete file. Okay, so when you're trying to qualify to buy, make sure when you're talking to a lender, you want to ask that lender for that middle score. Without that middle score, you're not going to be able to get an accurate quote. You want to make sure you get an accurate quote by getting the middle score, right? A lot of lenders cannot give you the credit report, right? It's a safety issue, right? The Safety Policy Protection Act, right? That a lot of times they don't have to give you a credit report, but they will give you the credit score when you're talking to a lender, right? You don't. Well, what's my experience, TransUnion, and Equifax? You don't need to know that. You need to know your middle score. Once you get that middle score, you can go out and shop for your home, okay? So what score is the best score? Of course, depending on the program you're trying to qualify for, right? Your credit score decides you're going to qualify or not qualify. It also decides what program you're going to fit into. And of course, you're either going to go with a government program or a conventional program, right? So if you're going to go with a government program, the score, even though it's 350 to 850, right? You want to be between 580 to 680 if you want to go with a government loan. So FHA, VA, USDA, you want to be between 580 to 680. But to maximize the best deal on the block, you would need a 640 score right now, right? A 640 score will get you the lowest interest rate or a lot of closing costs, right? That's why it's good to have good credit. But don't let lenders scare you. We had a consumer that reached out to us, right? And their lender told them, because you don't have a 700 credit score, you can't get this specific deal. And I was like, poppycock, no, you don't need a 700. She had a 641. Because of her 641, she could have gotten a smoking deal. But instead, she went with the lender, and they're already close to docs. There's nothing anyone can do unless you want to ask the seller for an extension. But because it's a seller's market, the seller needs that money to get into their other home, so they didn't want to ask for an extension. So don't wait till it's too late to shop your mortgage. Hopefully you take this information on credit score, and you know now how to make sure you ask the right questions and know the score, and don't let a lender pull one over on you. Oh, because you don't have a 700 credit score. You don't need one with a government loan. All you need is a 640. So because of 640, this other lender gave them a rate that was high and didn't give them any credit. And the excuse was their their credit score wasn't above 700, but all they needed was a 640, right? It cost her about $8,500. $8,500 in closing costs, right? So now she's got the loan with that rate, right? To get the $8,500 or the $8,400, she would have to take that same rate as well as we shopped it. But the thing is, she could have saved herself the $8,400. But now she's getting this home with that specific payment. You know what $8,400 can do? She can change your floorings, change your carpet, get washer and dryer, get a refrigerator. There's so much she can do. One thing I see people fall into all the time, they go out and they don't shop their mortgage. They don't get a second opinion, right? And now they go out, they use all their money to buy their house, and they have to go out and get a personal loan to put in new carpet, to put in new paint, or they had to get a personal loan, right, to finance the washer and dryer, or go get another credit, or max out their credit card at 24%, right? The reason why America's in so much debt is because we don't understand how to finance something correctly. And of course, I understand people don't buy homes every day, but you can watch What's a Mortgage, and you can share the information to those of you to those who you know are serious about home ownership. Oh yeah, guys, if you enjoy this content and you haven't subscribed to the page, do me a huge favor. Hit the subscribe button so you're notified every time we post new content or go live. We go live Mondays and Wednesdays on Facebook and YouTube, and we post content Sundays and Wednesday mornings at 9 a.m. on YouTube. So definitely do that. Also, guys, if I brought you any value, hit the like button. And if you know anyone who's serious about home ownership, do me a big favor, share this video or tag them on this video, all right? So definitely, guys, hopefully I'm bringing you value here. So next, let's talk about conventional loans, right? Like I said, your credit score will dictate if you go, qualify or not qualify. Also, what program you're going into. And of course, VA, you're with one program, but your credit score will determine, right, your rate and closing costs. But if you are not going VA, your credit score will determine will you go FHA or conventional. Of course, conventional ranges between 620 to 760. But you want to be at that 740 if you're trying to get the best deal. 720 will get you a good deal, but 740 and above will get you the best deal on the block. Not just the better interest rate, but also it will give you the cheaper private mortgage insurance. So if you're not putting 20% down, you want to make sure you have smoking credit to get a low PMI payment, right? Also, guys, with conventional loans, a lot more flexible than FHA loans. So what does that mean? That means when you buy a home with a conventional loan and you do not put 20% down, when you have enough equity, your PMI will fall off. So conventional loans, of course, with good credit, the payment will be cheaper than FHA, but it will give you the flexibility where you don't have to stress about refinancing if rates aren't there, right? Your PMI will fall off. It will automatically lower your payment once you have enough equity over a certain amount of years, okay? But if your FICO score is in that 720, 700, right? And you might want to shop it against an FHA, and sometimes FHA will be conventional. But I think above 720, 740 and up, conventional win hands down, okay? So if you're going VA, of course, you want to be 640, moving on, you're good. When conventional, it gets really tricky between that 680, 700, 720. That's why I recommend you guys run your credit before you buy your house. It's so important that you run your credit ahead of time, right? The last thing you want to do is fall in love with the house and realize when they run the credit, you're right there from getting a smoking deal, but you didn't prepare and work on your credit. So you always want to work on your credit. You always want to run your credit, know where you stand, so you could work on it. So when you find that dream home, you're not stuck with a boo-boo payment. Who wants a boo-boo payment? Not me. I want to maximize, right, my deal by preparing my credit. Well, what happens if I run my credit drops once they run again? If they run your credit for a home, your credit is good for 90 to 120 days, right? 90 to 120 days. They will not run your credit again. Well, what determines the 90 to 120 days? So after 90 days, the lender does something called a soft credit pull, which means they're going to pull, it won't affect your credit, right? And to see if you have any, are you applying for other credit somewhere else, right? Most lenders want to know, did you apply for more credit cards, a car, cosign, or did your credit get worse, right? Because you maxed out your credit cards. If they see a lot of activity, they will run a hard credit pull. If they don't see that much activity or none, they won't run it again, right? But after 120 days, if they run your credit, as long as you don't have a bunch of inquiries, you didn't max out your debt, right? Or cosign, your credit's not going to go down after 120 days after they run it once 4 months ago, right? You can talk to any lender, your credit won't drop. Majority of the times your credit will drop is because your balance went up on your credit cards, but you probably don't even know that, right? Because you start using credit cards more because you're trying to save for your down payment or save for closing costs, right? So be very careful using your credit cards or co-signing or applying for new credit, right, while you're shopping for a home. I see it happen all the time. Or the car lease is about to expire, right? Something like that happens, and then you have to run credit to get another car, and there's another inquiry, and for some reason that car credit company has to run your credit with 3 other credit car companies to qualify you for that car. So a lot of things can happen. So if you're serious about home ownership, you might want to put a pause on using your credit or checking your credit, right, to qualify. But, right, let's say your credit is on the cusp of breaking through, right? A lot of times what you can do is get an increase on your credit, right? Let's say you had $1,000 credit line, right? And you increase it to 2 or 3,000 after you make 1 or 2 payments, it's going to increase your credit score, right? A lot of times you want to be very cautious of trying that, right? If you know, hey, I'm at that 680, let me pay down some debt, let me increase the trade line, you might have to wait 2 months. It all depends on where you want to prepare your credit to buy. I say this, my rule of thumb. If you're working on your credit to buy, right, if it takes longer than 6 months or 3 to 4 months to do it, buy what you can buy with now, right? It might not be the best deal on the block, but you want to get in now because you don't know if that home is going to be available 6 months or a year after you fix your credit. I see so many people fix the credit. It takes a year, 2 years to fix, right? Oh, I want the perfect credit score to buy. And what happens when they get that perfect credit score, right? They get that score and all of a sudden, right? That home is not available. Remember, guys, the secret when you're trying to wait for the perfect situation, inflation. Take into consideration inflation when you're trying to save for a bigger down payment or work on your credit. When you set to save, remember, payments and purchase prices will climb with inflation about 3 to 4%. So you want to take that into consideration. Well, what happens if rates go down? If rates go down, prices go up, right? If prices go down, rates go up. So you want to watch the cost rise. Just like anything, right? When was the last time you looked for something where you saw prices go down? They gradually go up slowly, right? So the longer you wait to buy something, you will see payments, entry-level home ownership payments gradually rise as you wait for a longer period to buy, okay? So now that we know the perfect credit score to have, we know what credit score they're going to use, right? There's one thing people forget: public records, right? If you're looking to purchase a home, you want to pay attention to your public records, right? Especially for those of you who are buying FHA all the time, or some of you guys, you might have good credit, but you filed BK. If you had a bankruptcy, a Chapter 7, a Chapter 11, a Chapter 13, a short sale, a foreclosure, or a repossession, right? Maybe you might have the best credit, or you might be 680, 660, right? And you have the score, but for some reason, the lender can't approve you. It happens all the time. Actually, happened today, right? They had a 680 credit score, but they had a bankruptcy that's a year old. This person was smart. They filed BK. They started working on the credit, right? So if you have bad credit, the best way to build credit is to start getting trade lines and actively using it. So this person was smart. They were using their new credit cards once they filed BK, right? And because of that, they had good credit. But now they have good credit, but their BK is only a year old. So they would call that 1 year seasoning. As you guys look on the chart right here, can you bring it up big screen, right? So you look on the chart right here. So with a Chapter 7, right, it's 2 years BK seasoning or longer, okay? FHA, 2 years seasoning or longer. Conventional, 4 years seasoning or longer, right? So remember, it depends on your public records. If it's a bankruptcy, right, short sale, foreclosure of a repo, make sure that seasoning has passed before you're trying to qualify for that specific program, okay? So if you're trying to qualify for home ownership, make sure you're paying attention to that, right? I've seen people with a 700 credit score. They can put 20% down, but their bankruptcy is only 3 years old, right? And now they have to go FHA and they can't go conventional. Happens all the time. Doesn't mean they won't qualify, but I see a lot of people, well, I'm putting 20% down. I refuse to pay PMI, right? I'm going to wait till the seasoning's over, right? A lot of people can do that. But remember, if you do that, you have to, remember when I said if you do that, payment might go up in a year, right? Because remember, mortgage payments will rise, right, with affordability rising as well, with cost rising as well, okay? So remember, you can have the perfect score. You can have the right score ready to buy, right? But check that public records. It will be on your credit report, okay? So the one time I say it's okay to use Credit Karma, right, is to check for your monthly payments on all your liabilities, and you check your public records. I see people forget about public records all the time, but you want to make sure you see that. Last but not least, now we know, right, the score, how to get the score. What scores do you need to qualify, right? We know how to check public records. The next thing is, what score do you trust? There's so many different scores out there right now, right? With there's so many different scores out there from different companies, what score do you trust? Like I said, if you're applying for a home loan, you want a mortgage company to run your credit. If you're applying for a car loan, you want a car company to run your credit. If you're applying for student loans or credit card, you want those companies checking the bureaus, right? You want to make sure when you run your credit, they do a hard pull and not a soft pull. Without a hard pull, you cannot get an accurate interest rate to give you an accurate deal and accurate qualifications, okay? You do not want to use Credit Karma, credit card apps, bank apps, right? You want to use mortgage companies score to validate your credit, right? If you're serious about home ownership, you got to have it ran, right? There's no way around it. If you're just trying to check for monthly payments on what you owe so you can start preparing yourself to buy to make sure you qualify, right? Then yes, use Credit Karma, right? Yes, use these other free companies that will give you a score, but you want more than the score. Remember, those scores are not accurate, right? The score that's accurate is going to be from the lender. What you want to extract from these other companies, you want to extract the monthly liabilities, like your monthly credit card payments, student loans, car loans. If you have collections and there's monthly payments on it, you need those payments to generate, right, your debt to income ratio. So definitely, guys, when you run credit, you want to use a lender's credit to qualify the credit score, okay? But if you just need liabilities, doesn't matter who you use, okay? The rule of thumb also, make sure you're pulling credit from the industry you're borrowing money from. The last thing I would do, right, is I try to buy a truck, I ask them for a copy of my credit report, and I'm trying to use that credit report to gauge my credit to determine what type of loan I'm going to get, what type of payment I'm going to get, right? So it's so important that you understand that, right? So because people ask me all the time, man, I want to use my Credit Karma score. Or Credit Karma uses Vantage Score 3 as your credit score rating, right? Mortgage lenders, they're using FICO score 2, 4, and 5. That's why your Credit Karma doesn't work compared to just letting a lender run it once, right? All you guys, oh, my precious credit. I see people all the time. They hold on their credit. They fall in love with the house, and they think they have good credit because Credit Karma told them they had a 700. And now they have a 680. They went from going conventional to FHA and having permanent PMI, right? And it's okay to go FHA, but you need to know where you stand so you can prepare yourself for what's coming ahead. I see so many people, right, who love their home. They prepared correctly. So many people who don't love their home because they put their credit score, right? They trusted their credit score in the hands of a company that lenders can't use those credit reports or those scores to qualify you for home ownership. So it's really important that you use the right credit company, right? It's really important to do that because you can get the right score. Without right score, you can't qualify. You don't know what program you're going to go for. You don't know what your payment's going to be, right? Remember, love the payment before you love the house. And the best way to find out is understanding your credit score, all right? Hopefully that was helpful. Guys, let's go to some Q&A here. Sal Ortega has a great question. Is there mortgage lenders with no PMI? No, there's not a mortgage lender out there with no PMI. All mortgage lenders will have PMI if you don't put 20% down on a conventional loan, or if you buy FHA, you will have PMI, okay? And that PMI on FHA is permanent unless you refinance out of your FHA. On conventional, once you have enough equity, you won't have PMI. But Saul, let's be real here, right? What would you rather avoid? You can't avoid both. You can avoid PMI or you can avoid inflation. What you want to do, Saul, run the numbers. Great question from Genevieve. I have a part-time job that I've been working at since August 2020. I will continue to work with them for at least another year. Can I count this income? So if you have a part-time job or a seasonal job, as long as you've been there for 2 years and you're still working there, you can count it as income. But if you have a full-time job and you got a part-time job, you would have to have 2 jobs for 2 years to use both income to qualify for home ownership. So if you have a full-time job over 2 years, you got to get a part-time job in August. You cannot use that job you can't use the income on that job to qualify because you don't have a 2-year history. Hopefully that helps you out. All right, guys, I really appreciate everyone who commented on here, everyone who liked and shared. Guys, we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you guys so much and enjoy the night. Again, thank you so much for watching our show. If you have any challenges or concerns regarding what's a mortgage, call me 714
332-2526.